Hello, everyone. Welcome back to the Daily Gold podcast. This is being recorded on Thursday, April 3rd, 2025. And with me is your favorite guest. He is Professor Vince Lanci. He's with Echo Bay Futures, also publisher of the great GoldFix on Substack. And Professor, there is so much to talk about. I know you've been covering everything. You're exhausted. So I and my listeners really appreciate you joining us today to discuss everything. And I'll just give a preamble here. Professor, at the end of February, there were some key developments, and you touched on that. And that was we started to see money moving out of tech stocks and into gold. And the gold to stock market ratio was really close to breaking out. And it finally did at the beginning of March. And that keyed a huge breakout in gold against the 64/40 portfolio. So it's something we've been talking about the last couple of years. Huge breakouts, really critical for the precious metals. Big moves up until this tariff news. We could continue to see money coming out of tech stocks. On the day we're talking, yes, silver is getting hit. But if you look at the way silver stocks have acted in previous days, they were hinting that silver had already peaked. Big selling in precious metals. But, you look at the miners, they've come all the way back. A lot of buying since the open. Whereas with the S&P, since the open, you've seen selling. So some turbulence in precious metals today. And in the last couple of days with respect to silver. But in my view, the big picture has never looked better for precious metals. And so if we're taking a 50,000-foot view, for me, everything really looks really, really good. But I know that you're covering the market, hour by hour, day by day. And so there is turbulence going on there.
Yeah.
Again, I know there's so many things to talk about. I know you're exhausted,
Well, give
but
me one. Give
what,
me
yeah,
one.
what,
Uh, why don't we start
well,
with
all
the
right.
six? Why don't we start with the 60/40 because you alluded to that what we talked about in February and I think March. Um, about a year and a half ago when you started indoctrinating me with the 60/40 portfolio, that was like your pet project when you were getting ready to write your book. Um, I started paying attention to that, and that's actually when I took a more of a closer look at miners. I bought a little bit of Newmont when Druckenmiller bought, but I'm not a mining person, right? But I do pay attention to stocks and the 60/40 portfolio, that whole downward sloping channel at the bottom that you drew. I started paying attention to miners with respect to gold, and about 4 months ago, I noticed that the U.S. ETF buying had returned. Okay. And we all know that now. But 4 months ago, I noticed that the ETF buying had returned. And it returned at first because Powell was in the process of cutting right before the election. And when he stopped cutting, I noticed that they didn't keep buying, but they didn't sell. So those that were buying it were holding it. And then behaviorally, little by little, it started to happen. Stocks would go up, and I'd look at gold, and gold would go up with it. Stocks would go down, and gold would stay firm. And at first, I'm going, that's gold. It's because of the tariffs and all that. But then I started watching miners, right? And GDX, I started looking at, not charting, GDX versus QQQ, and I started looking at some things like gold versus the S&P, all simpler versions of what you were doing. And I concluded that every time stocks would rally, they were losing momentum and GDX was gaining it. Every time stocks sold off, GDX was relatively holding firm. So about 3 months ago, I put on I'm not a naked miner person, not normally, right? I put on a GDX versus AIQ. The AIQ is like an AI company stock. I have some charts here. We'll look at them in a second. Kind of like a Mag 7. And I didn't lose money. In fact, I made money, but not from the GDX. I made money from the AIQ. And so I said, well, maybe I'm just short the stock market and miners are going nowhere. And then I started paying closer attention. And in fact, it looked very good. ETF money came back again. Goldman upgraded their recommendation for gold because of the physical demand. And all of a sudden, I started seeing some real performance. Then, about a month ago, Michael Hartnett has this. This is all about miners here. This is me coming to the conclusion to my miners, right? Michael Hartnett, about a month ago, has this BIG uh, concept called a theory, right? And basically, he was saying that US exceptionalism is weakening. So sell US stocks and buy international stocks. That's the I in big, BIG. And the B is own bonds because he felt a recession was coming. And the G is own gold for related reasons. And when you put these dots together, they kind of form like a ring. And the ring is this. If you're selling US stocks and buying international stocks, what you're really doing is you're buying emerging markets. And emerging markets are basically gold. The emerging markets and gold have a very close correlation with the dollar. So if you're saying buy bonds, you're saying sell US stocks. If you're saying buy gold, you're saying buy gold miners. And then, so he indirectly was saying to readers, uh, miners are a buy on a relative value basis. So that's when I started to put that position on. Then 2 weeks ago, we started getting some real mining recommendations. Uh, RBC. It turns out that the clients of these banks, I'm talking about American clients, this is what the normies are doing right now. They're calling up the banks and saying, hey, this has happened when gold hit 3,000, basically. When gold hit 3,000, the bank said, how you doing? And the client said, hey, gold's at 3,000. I want some exposure to gold. And so the bank would say, well, let's buy some ETFs. And there was a lot of pushback, my understanding. And the clients were saying, no, I don't want gold. They don't want to sell gold anyway, because it's an ETF. They don't make much money on it. I want to buy something that moves like gold, but's undervalued. I mean, literally, they were saying, I want my money to stay in equities, not gold. I mean, right? So that's the sweet spot for banks. Sweet spot is because the banks do have the analysis and they've known about miners being undervalued for years. So all of a sudden, it's not like they just discovered it. All of a sudden, RBC, Bank of America, and Citibank come out with these amazing reports talking about miners. And they weren't sales pitches. RBC was basically just a laundry list. I think I sent you a copy of that. RBC was basically a laundry list of all the stocks that had, the title was specifically mining stocks that have direct correlation with gold. Not streamers, not hedged companies, mining stocks that move with gold that have basically unhedged exposure. So RBC was like, here's the list, ranked best to worst. And then Bank of America, the day before, comes out with a gold mining primer. Like, this is the title was like, gold. The title was gold stocks with exposure. Just like I said it before, I'm reading their title, gold stocks with exposure to the metal. And it was a great report, and I wrote it up, and I went, wow, that's 2 reports. And I just started nibbling with the miner thing. And at this point, miners had already appreciated, right? So then Citibank comes out with it was a PowerPoint. It was a slide deck. But they put 5 bullets in there that were the story that you want to hear if you're a miner. It wasn't a story, it was the facts. Let me see if I can think of them in order. Number 1, miners are at a 40% discount to where they should be. Number 2, miners are a 40-year opportunity. A gift to the expression was, the mining companies themselves have a gift to make money, and that is low energy costs, which we've talked about, right? You talk about it all the time, right? Number 1. Number 2, high interest rates. The interest rates are high. So if gold's trading 3,000 up front, 1-year gold is trading 3,500. So if you hedge your production a year out, you're going to capture a lot of that interest rate carry too. And so they were going through that. And then they said, this doesn't happen that often. And then they said, the miners are about to start, we believe the miners are about to start increasing their dividends and buying shares back. Now, I don't know if that part's true, but that's what they said. And the pieces that went through it were just like, wow, this is really good. I started as a fundamental analyst. This is really good fundamental analysis. And I said, that's it, right? And then I looked up, and then I started looking, and I got longer. And then of course, that was the top for miners, right? Starting when gold hit 3,000, it's like miners are done. They stopped moving, GDX didn't move, for like a month. And so technically they're working off some overboughtness. I don't know how you want to look at it. Maybe maybe they're signaling a toppiness in the bullion market, which is, I think you said that earlier today. But I put on this GDX versus MAG 7, it's called MAGS, and I put it on versus AIQ. So I had this like large arbitrage on, and GDX didn't go anywhere, but I made money. So we come back to this, and I go, let me look at Jordan's 60/40 portfolio, that chart. And I went, oh, look at that. It's breaking out. And it's breaking out because stocks are dropping, not because miners are rallying. So here I am looking, gold's at 3,000. Banks are telling clients to buy miners. Stocks are dropping. And I go, this is perfect. And so when everything dropped with the tariff part today, before the US Open, I said, oh shit, they're going to slam miners too. Classic, liquidation. And then I'll have to decide if I want. I figured I would be flat today because I'm long miners and short everything else. Well, on the open, stocks were cratering, cratering in futures. And then on the open, stocks continued to sell off. And so did GDX for the first 15 minutes. And then it took off and went back to unchanged, despite gold being soft. So I think we're in a new era. I really do. And the tariffs were the push to get us over the edge. People want out of stocks. They want exposure to gold. Financial companies are going to be weaker because of this. Precious metals are going to be a safe. Now, silver's an exception right now, but I do believe that I'm going to add to my position. Let's put it that way. All right, I'm going to add to my position, and I believe that there will be more selling. What's the word you use? Turbulence? Would you use another word?
Yeah, turbulence, I guess.
Yeah, that's a good word. That's a good word. It's a good word because we're going to see that there's turbulence in silver. We're going to talk about that as well, right? But I think the charts will tell the story. I'm giving your viewers the fundamentals behind and the analysis behind the things that the chart is telling you is true. The chart leads the news, Everyone's like, oh, technical. The chart tells all. You just have to know how to read it. And the news, for me, confirms the chart. So I'm very happy with that. So that's my long version. I believe there's your title. I believe from a non-technical point of view, it is a new era for precious metals miners. That's it.
Yeah, there's just I guess a couple points I want to make. Number one, with respect to a new era, I think you're absolutely right. And again, looking at gold against the 60/40, I updated my data yesterday, making it go all the way back 100 years. And gold breaking out against whether it's the S&P or the 60/40 portfolio, you can see these huge changes. This is only the fourth one in the last 100 years. So this is
Right.
really significant. This is not just like this is like a 1 year or 2 year move. And Professor, when you break out of a 10-year base, well, let me step back for a second. So gold, we're basically 12 months after breaking out of a 13-year base, breaking out of the cup and handle pattern, 13-year base.
Right.
Now, earlier, or I should say last month now, because we're speaking in April, last month, gold against the 60/40 breaks out of a 10-year base. I mean, those are secular. The implications of those breakouts are secular. That's just not something that's going to happen for a couple years or even 5 years. That is going to last longer than most people are thinking. And just to stretch on my first point, I think you probably agree with this. I think, at least the smart Wall Street people, they're figuring out now um, that what's going on in gold, or what is about to go on over the next few years, like this is not some temporary thing. Like I get the sense, at least, before the last couple of days, that maybe the normie or kind of some of the Wall Street people, they had this thought, they're like, oh yeah, gold's doing great. It's gonna make a blow off top here in the next couple of months, and then I'll just go back to stocks. But these breakouts, the two that I mentioned, they're saying that's BS. Now, the second point with respect to miners don't follow gold. They follow basically the real price of gold, which is, gold divided by inflation, or gold against the stock market, gold against the 60/40. So when we're looking at the real price of gold,
Uh-huh.
gold has to outperform other assets, other investment classes. And when that happens, that's when you get the leverage. Essentially, gold is going up faster than its costs are rising. And
Right,
so, so that means the real price of gold is moving aggressively higher when that happens. And that means the miners, I mean, they're having increasing leverage to the price of gold because their margins are fattening and widening. And just the last point on that, gold against the CPI, so the inflation adjusted gold price. The gold stock indices track that really, really closely. So gold divided by inflation is a really good proxy for the profitability of miners. That on a monthly and weekly basis has now broken out of a 45-year base. And so you break out from a 45-year base, and that's an indicator for the miners. What does that tell you? Could happen in the next couple of years if that price goes higher. I mean, shit. You look at, I mean, because I cover the miners and the juniors.
right,
If you look at right now, I mean, there's so many of these companies, like they're generating shit tons of cash flow, literally shit tons of cash
right,
flow. They don't even like these companies that are growing production and building mines, they don't even need margins to increase. They are making tons of money right now. Even if margins go down 5 or 10% and they, double their production over the next 2 or 3 years, they're going to make tons of money. But what happens if the inflation adjusted gold price, which just had a 45-year breakout, what if that actually acts like it should when you break out of a 45-year base? Um, and you get, like, let's just say a year from now, you have 4,000 gold, but costs are up only like 2 or 3%. The
right.
margins, yeah. I know I'm babbling on here, but
No, no,
well,
no,
I
I'm
guess what I'm
listening.
saying, miners and juniors are in a really good situation, especially producers and those who are going to build mines in the next year or two. It's a really good situation right now, but it could get even better. It could get historically good in the next year or two.
Right, right. So you're talking about, all right, gold versus inflation as a proxy for kind of like all-in costs, real costs for miners, which would indicate that low sustainable energy prices and declining inflation are good for miners and their operating costs, not just the price of gold. That's what you're saying, right?
Yes, exactly. And so, yeah, we know that oil is a huge driver of global inflation and
Right.
general inflation. And so, yeah, to put it simply, uh, gold against, I mean, oil is a little too volatile, but gold against the CPI is a
Right.
great fundamental indicator
What does
for the
that
mining
chart look like?
companies.
I think I pulled it up. I wanted to share it with you. Is gold versus CPI kind of like a weekly chart that rallies and then we have a big fish hook?
I mean,
And now,
it looks like a cup and handle going back to 1980. Because I'll throw it up on the screen when we edit this, but it has a peak in 1980, and then another peak in 2011, and then another peak in 2020. So it looks like a huge cup and handle, and now that is broken out to the upside. And if you look at like the Barron's Gold Mining Index, which I have data on that going back 100 years,
right,
other than the 1960s, it tracks the gold stocks track perfectly to the inflation adjusted gold price from like a 50,000 foot view, because we only
right,
get the CPI only updates every month. So, I mean, it's
right,
only 12 days out of the year. But generally, that is a really, really good proxy for the miners because it totally makes sense when you think about it. I mean, how can you track the margins of gold companies? It's the price of gold minus or divided by the costs. And so
right,
CPI is the best indicator for the costs.
right, right. Right. So, real gold in real terms, or I'm sorry, gold in the real price of gold, so gold minus inflation. We haven't made an all-time high in that price yet, have we?
Gold divided by inflation.
Yeah.
I think we have on a weekly and a monthly basis. Now, on a daily basis, because you have that huge spike in 1980, I don't know if we've done so, but we have made a new weekly and a new monthly high.
Okay. I want to pull that chart up. Can we pull that up together? I want to take a look at it. Can you
Sure, let me just, yeah,
let's
I'll pause for a second.
so
Okay.
this is your chart. What am I looking at?
Okay, so at the top, that's gold divided by the CPI.
Uh-huh.
At the bottom, that's the Barron's Gold Mining Index. Now, the Barron's
Right?
Gold Mining Index, it's a little different than GDX, XAU, et cetera. I think it has a lot fewer companies. I think Newmont is a pretty big weighting, so that's why
Right.
the index was pretty high in 2022. But anyway, Professor, my larger point is if you look at just the moves and the slopes of both, like they're very similar. You can see, you had the big move up in the 70s, and then you had a move down from the early 80s to 2000 in the gold stocks, and the same thing happened in gold divided by the CPI. And
Right.
if you look at since you go back to 2011, 2012, they look pretty similar. You had gold against the CPI from 2011 to 2016. That was almost, I mean, that was over a 30% decline in the real price of gold. And so that's why, the gold stocks basically crashed. So you
Right.
look at again, I mean, it's not a perfect correlation, but it's damn close in my opinion.
Right.
And
Right.
one reason I would say, so the gold stocks are a little, they are a little undervalued. Like they should be probably 20 or 25% higher. The reason is their valuations. Their valuations have moved up a little bit, but their valuations are nowhere near where they were in 2011, 2012, 2010.
Oh, really?
Yeah,
So when
I
you
mean, I
say
have that.
valuation, do you mean price to earnings, or do you
Yeah,
mean
price to
enterprise value, or
cash.
EBITDA?
Yeah,
Okay.
EV to enterprise value to EBITDA or price to cash flow, which is my favorite.
Right.
Yeah,
Right.
price to cash flow typically ranges from historically it's gone from 5x to 24x, most of the
Right.
time from 6x to 20x. And I think a couple months ago it was around, I want to say 8x. So I mean
It's
it's
so
probably
low.
higher now. Yeah, I mean the valuation could go up 20 or 30% easily and not be at an extreme level.
Right. Right. Right.
And so
Okay.
this chart, by the way, you look at the top one, that's as of February. So that does not include March because we have not got a CPI print. But look, if you even, I was just estimating in my mind like that, it's probably at like 9.6 right now. So
Right.
as far as the monthly and weekly close of gold against the CPI, it's at an all-time high. And it might be close to the spike in 1980, but I'm not sure yet.
Well, I mean, I'm just being naive here. It's above 1980 right now. You're saying we have to wait for the April close?
Well, this is a monthly chart. So
All right, so we have to wait for the March or February data to come in?
Well, it's when the March data comes in for the CPI, I think we're going to be way higher. Like we're going to be at 9.5, 9.6.
Okay.
You can see it closed at 8.93. So what I'm
Right.
saying is basically in this is a monthly chart. As far as
Oh,
the
this is monthly
monthly
chart ending in March or ending in February?
ending in February, at the end of
Oh, so we have
February.
another month in there. Oh,
Yeah.
shit. Oh, yeah, it's definitely higher. Right, right,
Yeah,
right.
so the monthly and weekly charts have already broken out to a new all-time high.
Right. So
And
that's
so
that's a, that's a key to buy miners. It really is.
yes.
You know?
And yeah, and
And
as I was saying, why I'm so excited as a minor and junior guy is things are damn good right now as far as margins. But you look at this chart breaking out of a 45-year pattern, um, that their margins could get, seriously fat in the next few years.
I'm wondering if I should just thinking about like as a trade, I should buy miners and sell gold. I mean, there's a lot of risk in that, but that's something that I would do.
Yeah,
Um,
I like the other pair trade a lot better. I just
right, equities to equities, commodities to equities don't work. You don't want to do that. You don't want to do that. Equities to
yeah,
equities. So short tech and long miners. Yeah, I agree with you. I agree. I agree. Can I want to pull up another chart that
okay.
you
Yeah,
mentioned.
let's go through the other charts.
So let's go through these other charts right now. And all right, so this is a chart that I started looking at since we had our conversation. Now, it's not much to look at, but when you think about what happened during these time frames, this is the SPX divided by gold monthly. So the blue line going across, the green line, I should say, is struck at 2.0. And the reason that number is significant, and this number comes from Goldman Sachs, a trader at Goldman Sachs, actually. Uh, come all the way back to the 70s. You got me going all the way back now. All right, that's even too much for me. All right, so here we go. Here we go. So this is more like it for me. All right. Um, the market crossed below 2 this month. There were only two other times during the time frame that I looked at where the market went below 2. This was stocks dropping versus gold at the beginning of the financial crisis, below 2. Stayed below there for significant time. And this time here is a hiccup. That's COVID.
COVID.
This is significant in that it's broken through on a path, right? It's not, there's no crisis, there's no event. I mean, maybe you can call the tariffs an event, but this says to me that it's kind of like, it's kind of not kind of like anything. When a stock gets below a 200-day moving average, the expression is nothing good comes of it. That's like a Paul Tudor Jones statement that came up recently. Nothing good occurs below the 200-day moving average. And for me, this line is the 200-day moving average. So that's the first thing that made me more interested in miners because gold is definitely moving. The other one that you alerted me to. This is GDX minus QQQ, right? And that's
Is
the
that
breakout that you were talking about.
is that a monthly line chart you have there?
It is. Do you want candles?
Yeah. Well, because if you do a weekly or a daily, you can see that beautiful double bottom.
Oh, there it is. Yeah, 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 yeah.
Because
Right, right. That's
we talked about this. You brought this up in our last monthly interview, and it's this the it, and you know I think I mentioned how bullish it is,
Oh, the
and
double bottom got me excited. I remember
yeah,
that. Yeah,
it only looks. I mean, it's only looking better. It's only gotten stronger in the last month.
I know. I know.
And
That's
again,
crazy.
based on what we're seeing, gold against the 60/40, gold against the stock market, or the stock market breaking down against gold, as you just showed,
Right.
that's that's more. I mean, that's more than a little blip here. Like it's really significant.
It is. It is. I mean, this is uh one of those wedges, right? This is the wedge. Oh, we broke the wedge, you know? Well, guess what? We actually did break the wedge this time.
That's a real that's a real trend line break, not the the so many false ones you see on Twitter.
Exactly. Wait. Let me just draw. I'm learning my tool here. There, I drew a straight line. I'm bullish now. Well, now you're bullish,
Yeah.
of course. Now is the time to be bullish. So this goes at minus 400 to minus 240. Could you explain that? What kind of a move is that?
Well,
Like in
you're doing subtraction. So GDX minus QQQ.
yeah. So that's like uh 140-point move in GDX. Am I looking at that right?
So let me see what's the nominal of QQQ right now.
Uh
So
I have it over here.
GDX is in the low 40, so 454.
Here
Okay,
we go. Here we
so
go. GDX is 45 and QQQ is
454.
okay. All right.
So
So
if that goes to 200,
If that goes to
So
260, no, let me just paint the fantasy here. We're having fun. If it goes to 260, that's because QQQ loses 100 points and GDX doubles. Now I know you're into juniors, but I'm looking at it that way, you know. Um, looks good.
90, yeah, that would. Oh yeah, yeah. No, that'd still be a hell of a move.
It would. I mean, why can't it get back to that? Why can't it go there? You know, I mean,
I
why
think it
can't it
will.
go? Look at that. Why can't it go there? GDX doesn't have to gain 500 points. QQQ can lose 100. And that's I think we're in for that. Tech stocks are going to get fucking destroyed, Jordan. It's easy to say it because they're down, front running on. What I mean is it's the reaction to the tariffs. Europe is going to attack our service sector. Europe is going to say they're going to tariff Amazon. They're going to tariff Meta. All the American stocks that operate in Europe are going to be punished. That's where we are. Let me stop sharing this.
And just a quick comment on that. And you have with respect to tech stocks, you have the double whammy because their business is actually going to be hurt. And you know this. You're in a bull, you're in a secular bull market. These stocks go up. Obviously, their business is good. They're making more and more money, but their valuations go up at the same time. That's why you get these huge 50%,
Right,
70% declines in some of these high flying stocks because it's like, oh shit, now their business is going to suffer. Their valuation, they're not going to trade at 60 times earnings.
right.
They'll trade at 20 times earnings.
The hope is dashed. It's basically the expression is. We went from being a unicorn that could make money to being a real
Yeah.
company that makes money, and that's another thing. China is doing that as well. China is China's AI is showing that it can be done for less money, and it can be done for less profit. So you don't have to spend as much money, so you don't have to charge as much money, and that's putting a big hole in U.S. Services tech stocks, and I think it's going to continue. Anyway, back to the metals. Where are we now?
Okay, so I think two things we could touch on before we let you go. Let's talk about the silver and the tariffs. Or do you want to do tariffs first?
Yeah, let's do tariffs in general. Let me think about that. 'Cause I just been doing a lot of it on the broader market, but let's just focus on tariffs and precious metals in general. Okay, so the tariff announcement came out, and it's worse or bigger than people expected. And without getting into the minutia of the details, I have that all written down somewhere. It's leaking out of my ears. But the situation for metals is actually very simple. There are no new tariffs on metals right now. So that includes base and precious. So gold, silver, and copper for our conversation right now. And what it does is it makes gold hold its value relative to stocks, but it's not bullish gold right now because you have a lot of length that has to work itself off. So an example of that would be a lot of people bought gold on leverage because they thought the tariffs would come and then the price of gold will go up here and then they wouldn't, it'll be a higher price. And so they're wrong and they have to sell it now, or they're not selling it, but it's easier to understand in silver. Silver, anyway, the tariffs are increasing volatility, but they're not decreasing the thesis behind it. Now, for gold, it's very simple. If we're using tariffs, then the price of gold goes up because you're causing a potentially stagflationary environment. You're buying more gold. Even if you bought gold that you shouldn't have bought, you're going to be able to hold on to it longer. So that's the first reason. Stagflationary environment. Second, related to that, the Fed, it looks like the Fed's going to cut, but there are new concerns that if the dollar continues to crap out, then that will be what's called a disorderly unwind. And a disorderly unwind in the FX market means everyone starts pulling their money home irrationally, okay? Or maybe it's not irrationally. And so the dollar keeps weakening, and that makes it hard for the Fed to ease. And if they don't ease, then that's bullish for gold, okay? Because it's going to be an acceleration of everything's bullish for gold right now. It really is. I wish I could say that about silver. Okay, so the next thing is when you do this, you tell the rest of the world, we don't want to do business with you. And so they don't need to use dollars. So they're going to buy more gold and sell some dollars out. So it accelerates de-dollarization with trade partners who are strong. Trade partners who are strong are going to just say, we don't need you anymore. Sell your dollars. Now, how many trade partners are strong after this? Probably only one, probably China. You're going to start seeing capitulation. So as we start seeing capitulation from smaller countries, that's a sign that things are easing. And if they ease, gold should sell off. But without jumping around with too many areas here, tariffs and what's going to come from the other countries, unless it's a complete reconciliation and everyone hugs it out, we're entering an era of international trade that is going to be more reliant on gold, and it's going to be more reliant on gold as a hedge, and it's going to be more reliant on gold as a substitute for the dollar. So that's a lot of word salad there, but gold's fine, is what I mean to say. Okay, silver's more complicated. Last night I sent a letter, I sent a message to subscribers, and gold was up right on the tariff announcement. Gold was up, copper was down, and silver was unchanged. And I went, perfect. Gold is precious, copper is base, and silver is confused, was the word I used. Silver doesn't know what it is today. Well, the problem is when Trump said no new tariffs, it affected silver the most because so many people had bought silver. Like, for example, I talked to an industry executive today, and everyone was front running the expectations of tariffs. So GE was buying all of its industrial silver going out 6 months, a year, who knows? They were just buying a shit ton of silver. So the tariffs didn't come, right? GE, they're not going to sell their silver, but they don't have to buy anymore. But the tariffs aren't here, and anyone who bought silver front running GE, oh, GE's buying it. Tariffs are coming. Let me buy silver. They were buying silver on lease. They were physical silver on lease. They were buying silver on leverage. Well, they're going, is it precious or is it base? And they're just selling it. They're getting out. So they're actually selling more silver and buying gold. We could theoretically, I don't know yet. This is not something people want to hear, but we could theoretically, in the short term, because of the lack of tariffs on silver and because of the pre-buying stopping, you could actually have a short-term glut. Okay, and that would mean we need to work off some of the supply. I know people are just cursing at me right now for saying that, but I mean, I'm long silver. I just took delivery of I just bought a monster box, so I'm not happy about it either. But I think I think if you were to translate everything I'm saying into the charts, it kind of, there are other technicians that I've talked to. I don't cheat on you, but there are other guys that I talk to, and like, for example, Michael Oliver's one, and he'll say I like gold, period, right? And then he'll say I like silver, but it's going to be volatile. Now we've all said that a million times, but it's kind of true. And that's why I wanted to ask you about silver because it's a more difficult chart to deal with right now, and I wanted to get your feel for it.
Well, I think what happened, I mean, it's great that we have the fundamental or the day by day or hour by hour
I'm sorry,
picture from
I
you.
didn't mean to put you on a spot. I mean, I know you can't share your screen right now, but I'm asking you like as a client.
Oh,
What do you think
I
about
was
silver?
trying I was trying to provide some color. Basically with silver, $35 silver is 2100. If you
What do you
think
mean?
about, okay, for gold, remember gold, 2100,
Yeah,
gold had to get above 2100. For silver, it has to make a monthly close above 35. I mean, we've been talking about 35 for the last couple of months.
right. That's right. That's right.
And so and I'll put in a chart here, but if you look at a monthly and a quarterly chart of silver, silver, I believe the quarterly close in silver, just on Monday, That was the fourth highest close ever, silver futures. Now,
Right.
if silver it closed below 35, if silver would close like at 35, 50, that
Uh-huh.
would be, I think, the second highest quarterly close ever. So
Right.
basically, and there's a little bit of resistance at 37, but basically we're looking at 35 for the most part.
Right.
35 and 37 are the remaining resistance levels for silver. And there's a little bit, around 40. But once silver has truly taken out 35 and moved above 37, like that's when you're going to see momentum really pick up. And silver, after it breaks 35 and 37, that's going to act the way gold did when gold broke or after gold broke 2100. So
Right.
for silver, it's clear $35 is the key. And the other thing I'll mention is we had that day where I think silver closed above 35, silver futures like a week or two ago.
Right.
The silver stocks completely yawned. Like the best juniors, at least in my opinion, they did nothing. They couldn't even move when silver had that great day. So, and that's but even before today, we had the big dump in silver, but the silver stocks, they had already been hit. So the action in silver is not, I mean, it's not a huge surprise to me today, given how the stocks were acting in, the last, 5, 7 trading days.
Okay. All right. So yeah, it sounds like you're implying that if silver rallies and the miners don't, or even gold rallies and the miners don't participate, then it signals a short-term top potentially.
I mean,
Which might be what you saw.
especially after, you've had a period where you've been trending higher for a while and you've
Right.
had, very good gains.
Did you
I
hear that
mean,
noise in my background?
I think so.
Yeah, you know why? I just got an alert. Something bizarre just happened. Uh, hold on. Let's see what the hell's going on. Uh, Nothing we care too much about. Must be a foreign currency. Oh, platinum. Platinum just, I have a position in platinum. It just got stopped out. Platinum down 2%. All right, so maybe I'll buy that back in. Okay, so all right. Um, so we had a great month close, but a shitty month open. Do you think we could be higher in the month for gold? I know that you think we could be, but um, what do you think?
I think, well, because based on what, I mean, I like the action today, gold and gold stocks very strong in real terms. But what happened with silver in the last 2 weeks has happened with gold in recent days, where gold had gone up before today, had gone up like 70 or $100, and the gold stocks had just gone like that. They had not made any progress. So I think the market's going to sell off. But yeah, I mean, maybe
Right, we
it,
don't know
but
what.
it wouldn't honestly, if it moves lower, it wouldn't bother me. I mean, we've had a great move. Uh, gold has got to come back and correct that at some point. But I think this, and I think you'd probably agree with me for all the things you were mentioning at the beginning of the interview. I think the stocks, and remember, the miners had just broken out above 4.5 year long bases.
Right,
And we know that there's no money. I mean, based on fund flows,
no money.
there's no money in the sector. So I really don't see miners getting hit that hard, even if gold, corrects here a couple $100.
I
Yes,
would
they'll
never
come.
short a miner again if I was a hedge fund manager. Just there's no way to do it. It's like you just sell what you have now. Yeah, it's
Yeah,
gonna be
there.
bad.
I mean, and so I think, I'm kind of guessing. It's not like a sense, but it's just a guess. Maybe in the next couple months, precious metals correct, but for gold and gold stocks, maybe we get some kind of bullish consolidation. Maybe we
Right,
get some kind of sideways move in gold. I mean, because typically that's what happens with gold when it corrects and it's in a real bull market.
right,
It takes a big dump, and then the low is in pretty quickly, and then it consolidates and builds a base,
right,
or or it just kind of goes sideways and consolidates bullishly.
right. For the last year and a half, we've had the sideways consolidation, and before that, and that's a sign that we're in a good market. I think that the just to share the news items that are going to come out that would make you right, or wrong. Hopefully, you're wrong, right? Would be reconciliation, even though it's not going to put peace in the world, it's going to cause a dip in gold, right? Um, uh, China pushback is going to cause a rally in gold. It is. It's just this. And China's stimulus is going to make gold rally. China is going to stimulate their economy now. They're going to do a fiscal stimulus to counteract this. And although I don't know how they're going to do it exactly, I think they're going to basically give money to their people to buy things. And those people are not going to buy cell phones. They're going to buy gold.
Gold.
So, that's what's going to happen now.
But here's an interesting thought. I don't want to get too far ahead, but based on, stimulus and all that, is that going to be coming, 6 or 9 months from now after, we're in the damage from the tariffs and just the upheaval and all that? I mean,
You're
rate
talking
cuts
about the U.S. stimulus, or are you talking about China?
no, but I'm talking about the U.S. Maybe we will have to have a stimulus that follows China.
Oh yeah, we're going to. We're going to. It's going to be. If you look at what he did with that's a good point to bring up. If you look at what the tariffs are going to do, right? So he blanket tariffs the world, right? And those blanket tariffs are the negotiation points. Start high, negotiate lower. What are you going to give me back? That type of stuff, all right? That's the blanket tariffs. But he's also going to carve out certain industries. So for example, simplifying it, we're not going to tariff China anymore. It's not going to happen, but tariff China and blanket tariffs go to zero, but all of your goods, your cell phones, your cars, whatever, we don't buy cars now, but your cell phones and things that we want to make on our own here, we're going to tariff. So an example would be, I'm not trying to say Temu, T-E-M-U. All right, so TMU is their online company, so it's kind of like Amazon, and they do a shit ton of business here. Okay, even without blanket tariffs on the country, they can't sell stuff here without bigger taxes. Now, why is this stimulus related? Every industry that we stop importing, now Temu doesn't matter, but let's say it's steel or cars. We're not going to buy cars from Europe anymore. Well, we have to immediately subsidize our own manufacturing to get it going. So the U.S. is like, we're not buying your shit anymore. We're going to buy our own shit. So Trump needs to subsidize, which is stimulus, our manufacturing industry. So he's going to make it rain on businesses. Build a factory, I'll give you a discount. That's what he's going to do. That's going to happen. And on top of that, you could have PAL lower rates. I think Zero had said it first. What's going to happen? What are we going to get first? Fiscal stimulus, subsidies, or are we going to get monetary stimulus, lower rates? And I think the answer is, unless stocks go below, let's say 5,200, I think the answer is fiscal. So yeah, that's definitely coming. And by the way, for all of you people that are just looking at it from an inflation point of view, the cure for everything that's going on in the world is to print more money. Okay? We're in a deflationary crisis. I'm Europe, deflationary crisis. I need to build my own manufacturing, I need to buy my own missiles. Well, print money to do that. Raise your debt ceiling. China, okay, we're so dependent on the US dollar for circulation, the dollar is not, they're not going to buy stuff from us anymore. Well, we're making things that no one will buy. Who are we going to sell to? Saudi Arabians? People in Zimbabwe? No, we're going to sell it to our own people. Print money, give them checks, have them buy stuff. The U.S., well, we can't print money and give it to our people. Not right now. We don't need that right now. We need to print money and build the manufacturing, right? Because we don't want it's really what we're saying is we don't want our people to spend anymore. We're saying save money until the factories are built. So the cure for everything is printing money to keep us out of recession. Given the choice between deflationary crisis and inflationary crisis, not hyperinflation, central bankers always choose inflation. And that's it. Our inflation is going to stabilize between 3 and 4%, I think, even with oil lower. So the answer to your question is yes, our stimulus is coming. Oh yeah. But it's going to go to manufacturers. So that'll create jobs, build a building. Remember, Trump's a real estate guy. Everything for him isn't drill, baby, drill. It's build, baby, build. He's a real estate guy. He's going to subsidize real estate. I'm with him.
All roads lead to gold.
That's right. That's right. Gold. I mean, that's it. You need to buy you need to you need to buy gold. You don't own enough gold. I mean, it's crazy to say that, but you don't own enough gold. And it's probably going to drop, like you said, over the next week or two. But you buy gold because of the tariffs. You buy gold because of the inflation. You buy gold because the whole world is getting out of fiat. That's what's going on. It's a good statement.
All right, Professor, before I let you go, please tell our listeners about the work you do at
Sure.
GoldFix and how they can subscribe.
All right. Well, I'll be off tomorrow, so don't be upset if I don't send you 5 emails. But it's GoldFix on Substack. So it's goldfix.substack. If you look it up, it'll have VBL in front of it. If you go there, we send out about 2, maybe 3 emails a day. It's a bit of a fire hose, but there's no spam in it. In the morning, I do a broadcast almost every day. And in the afternoon, we do an email recapping what happened with news stories during the day. Sign up for free, sign up for premium. Happy to have you. And I look forward to seeing you guys.
All right, everybody should sign up for that. Just great coverage and analysis of the gold market and everything that impacts it every day. Professor, thank you so much for coming on. I know you've been very busy and you're exhausted and need to get some
So are
rest.
you. So are you. We're both,
Uh,
it's a busy market. It's the price we pay. I'm happy. I'm happy.
but hey, great work, and we'll talk again in a month.
Yes, hopefully. Oh, we'll be talking about, oh boy, GDX. That's for me, it's mine. You're juniors. I'm just long GDX now. So you'll get me buying juniors next month. How's that? Right? All right. Thank you, Jordan,
Love
for
to hear
having
it.
me.
Thank you for tuning into the Daily Gold podcast. For more interviews, editorials, and analysis, log on to TheDailyGold.com. And for premium coverage of precious metals and the best junior mining companies, visit TheDailyGold.com/premium.